Thank you, everybody. Today I read How to Win Friends and Influence People. And we promise no marijuana names in the portfolio, so no questions about that. So notwithstanding this week, we're in a bull market, right? And so many investors miss this bull market, but not our clients. And we're reminded again with this month's sell-off that the ride to the top has not been easy. 10 years ago, we were at the start of the financial crisis. Sorry to bring this up, but it looked like the world was going to end, and we couldn't blame any clients for wanting to bail out of the stock market. However, if you stuck with it over the last 10 years, you were well rewarded. Over the last 10 years, there's been a pile of bad news. And as you can see, if you look on page 19, we've listed just a few examples of some really bad stuff that has happened over the last 10 years. But yet, the market continued to go up. As the market climbed, there were those that said the easy money had already been made. Check out page 20 for, you'll see a chart of those saying the easy money has been made in 2011, 2012, 2013, so on and so on, so on and so forth. There were those that would tell you, you know, the next market crash is just around the corner. You can see that also. But for Baskin Wealth Management, we ignored this noise and we stayed fully invested for you. As you can see on page 21, many were scared out of the stock market. Many vowed never to invest in stocks again after the financial crisis. Well, those that did that missed one of the greatest bull markets in history. But not you. You maintained your patience with us, and we maintained our patient investment approach. So, you know, we're in the midst of a pretty nasty sell-off right now. But as you know by now, our strategy is to do nothing. It's really just to wait it out until the storm passes, because we're patient investors, and we're lucky that we have very patient clients. And you have to remember, even in bull markets, there are nasty pullbacks, there's nasty setbacks. Over the past 10 years, your portfolios with us have dropped over 5%, 22 times. I think we forget every year, these kind of pullbacks happen twice a year. And twice a year, it gets very painful. So my recommendation after having one scotch or three is to be patient and remember that these pullbacks happen, but the bull market may continue. Each time we've had these nasty pullbacks over the last 10 years, the market eventually settled, recovered, and went higher. And we're hopeful that that will continue going forward. So the point I want to drive home tonight is that we trust our research and our process, not fake news. Ultimately, we know the right approach is to own good quality investments, whether they be stocks in Canada, US, the rest of the world, bonds, preferred shares, and to stay invested. So let's talk about where we are today. The US market, up until this month, was having a pretty good year. The Canadian market, as David mentioned, not so much. And over the last 10 years, in fact, the US market has seriously outperformed the Canadian market. If you look at the chart on page 23, you can see that the US economic output, US economic GDP, has outperformed Canada. So I don't think it should come as a surprise to anybody why the US market has been outperforming the Canadian market. But I want to tell you guys what really matters to stocks over the long term. So let's think about the long term. It's not what Donald Trump is going to tweet tomorrow. It's not concerns about China or Saudi Arabia or NAFTA or any other of hopefully solvable issues. What really matters is profits and the level of interest rates. So let's talk about profits. Last year, corporate profits in the United States rose 15%. That's 15%. This year, we expect corporate profits to rise 20%. The earnings have been phenomenal. The market, maybe not so much, but the earnings have been phenomenal. And if the economy continues to do well, we expect corporate profits again to rise double digits in 2019. So eventually, stock prices follow earnings. I have a chart there that shows you exact correlation over time. If earnings continue to rise, stock prices will follow them. So no one should be surprised if earnings grow that stock prices will go higher. So why are earnings rising so much? It's the economy. I'm not going to call anybody here stupid, but it's the economy. And despite any uncertainty about trade disputes, economic output, as David mentioned, is growing around the world. And we want to get exposure to that. The good news is many of the US companies in the S&P 500 have lots of exposure to global growth. Second, you may remember that the US took some pretty significant tax cuts in 2018. The US cut its corporate tax rate from 35% to 21%. That's very meaningful. And we think those benefits will start to kick in over the next couple of years. That will benefit the corporations and their shareholders. Finally, we're seeing some tremendous profits out of companies like Google and Facebook and Amazon. These companies are really changing the world. We've never seen companies like this before, companies that have such unbelievable balance sheets, staggering growth rates. It's just incredible. So a combination of good global growth, strong corporate profits, the tax cuts are really doing a wonderful thing for stock prices up until this month. We don't know where the stock market is going to go, obviously, going forward. But as you can see on page 29, we have a chart there that shows you that stock prices tend to do well when the economy is doing well. And make no mistake, the US economy is doing very well. Many have attributed this month's drop in the stock market to the rise in interest rates. And yes, interest rates really do matter to stock prices. Why in the world would you own stocks if you're getting paid a decent return on your bonds or your GICs or your cash? Well, I got to tell you, even though interest rates have gone up over the past year, you're not getting paid a decent return on your bonds and your GICs. We use bonds and preferred shares as protection here for our clients, and no question, with the interest rates going up, the returns are better, but they still don't tempt us like rising dividends and rising stock prices. In the bull market of the 1990s, safe government bonds yielded 6%. In today's bull market, those same bonds yield 3%. So bond prices or bond yields have to rise significantly before we are tempted. I want to talk to you about a funny thing called Fang Man. So Fang Man isn't a giant robot serpent. Fang Man is an acronym for some of the largest companies in the world. It stands for Facebook, Amazon, Netflix, Google, Microsoft, Apple, and NVIDIA. That's Fang Man. It's an acronym. And these companies have been really driving the stock market, the US stock market, over the past few years. And if you didn't own these in your portfolio, obviously you were lacking. I'm pleased to say that many of our clients own a number of these names and possibly will own more in the future. This is not a new phenomenon. In every single up market or bull market, there's always a handful of companies that lead the stock market. It's very interesting that Facebook and Apple and Google, even though they've had tremendous rises over the past few years, are still very attractively valued. I guess so, more so this month. So let's recap. We believe we are still in a bull market for stocks. The expansion of the US economy is arguably the longest on record, and hopefully showing no signs of slowing down. Corporate profits are at all-time highs and poised to go higher. The unemployment rate in the US is at a 50-year low. The tax cuts are just beginning to kick in. Interest rates are still one of the lowest in history, and inflation is quite tame. So ladies and gentlemen, you may hate this bull market, you may hate the recent market sell-off, but I urge you to be patient with us and patient with your investments, and the best approach is to stay invested. I want to talk to you about a group of people that we believe are going to bring in the next bull market, and these are the Millennials. You've probably heard of the Millennials. You may have a few at home. There's certainly a few on the podium tonight. These are people born between 1981 and 1996, with the average age of 29. Now, this group of people is one of the largest cohorts in North America. There's over 80 million millennials in North America, 70 plus million in the US, 7 million in Canada. And they've been slower than their parents to get jobs, to buy houses, to start families. But we believe that in the next 5 years, all that is about to change. So if there's a few millennials in the audience tonight, I apologize for what I'm going to say, but we think these millennials are going to be just like their parents. They're going to get jobs, they're going to start families, they're going to buy houses, they're going to buy minivans, they're going to get dogs. And like their parents, and like me, they're going to fall asleep in front of the TV every night at 9 o'clock. As a result, we believe there's going to be an upcoming spending boom, and we want to make sure we take advantage of it. Oh, one more thing, there are over 300 million millennials in China. David mentioned immigration. One of the wonderful things that's happening here in Canada, and we are all seeing it, is we're having an immigration boom. The Canadian government has mentioned they want to bring in over 1 million immigrants by 2020. And this is really good news. Most of these immigrants are coming here with money, and many of them are prime-aged workers. We believe this is going to be leading a strong spending boom in Canada as well. So we're going to scour the globe and look for great investment ideas that we believe will benefit from what we think are two very powerful themes: immigration boom in Canada and the millennials. So I'm going to now introduce you to a millennial who recently bought a condo. He has a good job, he had his second child, and he's a really smart guy, and he's going to talk to you about two great investment ideas that we believe are going to be wonderful for your portfolio going forward.